So here we go, we're back making some videos on YouTube. It's been a while, apologies for that. It's been a busy week at work. We had Ofsted come in, so it's been all focused on that, and as well as that, I've not been feeling too well. So with work being so busy, and then me just being absolutely knackered, getting up at 4 a.m. in the morning and getting in quite late at night, and I've just been going to bed straight away, it means that I've not been able to focus on any YouTube. But hopefully, with a new week coming up, the videos will return going forward. So apologies for that, and hopefully everything goes back to normal now. We're going to go for the UK stocks I'm buying in December 2023, the last video in this series for this year. Obviously we'll carry on in 2024. I cannot believe we're towards the end of another year, but what a year it's been in the stock market. Hopefully you guys have done really well in the stock market. It's been a fantastic year for me, and hopefully we have some more bullish years after what has been an awful 2 years in the market. So we'll have a look at this stocks that I'm buying and selling. I have sold some stocks, and I'll talk about what stocks I've sold. I've been buying a few stocks, and I'll talk about what stocks I've been buying. This is a video series that I've done for many years on the YouTube channel. It just keeps that transparency up, so you know what moves I'm making in the market. I'm not selling anything quietly out in the background that hasn't worked out, and if there's a bear market, I still stick around and make these videos for you. And as always, these stocks I am buying are for a longer term hold. I am aiming to hold these for many years. They're not something that I'm buying and then selling next week. I am a long-term investor. So with all that done, if you could hit that like button, if you're new around here, subscribe. Let's get started on the stocks that I'm buying for the UK edition, December 2023. Now, if you do want to help support the channel, join the Patreon, £5 a month. As well as supporting the channel, I do reward you with 2 exclusive videos a week. Last week we dropped the stock request on Evolution. This has been a highly requested stock, and it's a 20+ minute video. The video itself took about 6 hours to put together, and there's some really good information on Evolution. So if you do want to see that, link is in the description. As well as that, I dropped my UK portfolio, so you can see how the UK stock portfolio is doing currently, and it's doing very well at the moment. I'm very happy how this stock portfolio is doing after the bear market that we've been in. So you do get the 2 exclusive videos a week. You get a Discord to talk to people about stocks, including me, and it's only £5 a month. Join through the link in the description. And if you want some free shares, join Trading 212. That is the broker that I use. If you join through that link, you can get a free share worth up to £100. But let's get on to the first stock I sold, and it was Revolution Beauty. So I believe I did make a video on this, but I also put it into this series because I always talk about all the stocks I bought and all the stocks I sold in December, and I did sell some Revolution Beauty. I still think the company is actually a pretty decent company, and I think that it will still do very well in the longer term. I just felt for me this was the right time to move away from the company, and I did take a really nice return of, I think it was 70% I sold it for. It's been such a busy month, I can't even remember. And the other one was Hotel Chocolate. We sold some Hotel Chocolate shares. I think it was for 30 or 35% profit. Same again, it seems ages ago since we sold it. So it's been a busy month. Obviously that came after Mars bought them out, and was a very good ending, I think, to Hotel Chocolate overall. I've got to say, I don't know if you saw this, it was actually an article that came out, and it was about the Hook Group, or THG Group. Matt Moulding, a very outspoken figure, and he was once again very he criticised the LSE, and I agree with him. You know, there is this kind of element at the moment that just doesn't seem to be going that well on the LSE at the moment, and maybe there's actually some good opportunities out there for buyouts as well. I think we are starting to see a lot of increased buyouts in the London Stock Exchange because valuations are incredibly cheap. But he came to a point of view that he said that the company IPO'd in 2016 at 148p a share, and at the time it had 85 million and 10 million on EBITDA. Since then it has doubled to 205 million and 24 million in EBITDA, and has been very successful. But the shares recently fell to 100p, and obviously that's below the IPO price. So you see 6 years of hard work, and it's valued less than the third IPO at, and you know, is the London Stock Exchange failing some of these businesses? And I've agreed multiple times. You know, I think that a lot of companies should look at moving, unfortunately, to a lot of other indexes. But at the same time, because stocks are so cheap at the moment, you are getting these opportunities where there's going to be buyouts that are paying, you know, over 160% premium for where the companies are at as well. So it definitely works both ways. So the first stock that I did buy was a stock that I have held for around about nearly 4 years now, which is JD Sports. So I've held this stock since around the CV dip. I bought the stock, had it for a long time. I actually was up over 100% on the position. Did sell some shares, but kept some, thinking, JD Sports, it's going to be very successful for many years. A bit like what Matt Molden said, and then out of nowhere, boom, the shares lose 60% of value. And you're thinking like, the shops have completely closed down or something, and that just hasn't. The share price has absolutely fallen off a cliff. But yet the company continues to deliver, which is insane. Now, there was a bit of a rally up to the start of the year, but since then, the stock has been falling more and more, and it then had another dip here. And I was about break even at this time frame that my mouse is just on here. And I could not believe we were at the same sort of levels that we were at in the kind of July 2020, and we were even at the same sort of prices we were at in 2019. It was just absolutely crazy when you look at the progress of this company. And I thought I'm going to buy some shares. Now I think really the only reason why the stock is down is because of Foot Locker. I think people are panicking and seeing Foot Locker's numbers and thinking JD Sports is going to do the same, but they've done anything but that. They've absolutely delivered it, delivered on financials. And recently, actually, in the last kind of week, it has had a pop-up of 30%, and I guess that kind of shows you that some of these UK stocks that are just undervalued for so long can be painful for so many months, and then they can have that very quick pop-up. It is at 43 times earnings, but that's actually off a one-time charge. So it's actually around about, I think it's 11 times earnings now, which is still cheap. A little bit of a dividend out there. Now, I'm sure most of you guys know JD Sports. They're all on the high street of the UK. The big thing we're looking at, though, is the expansion into the US. They're really expanding into the US, and that's what's been driving the growth up in the last few years. And if you have a look at the numbers, absolutely fantastic numbers, like I said. In this environment as well, they've been doing these numbers. 8% growth, as you can see down here. Net cash up 26%. I mean, look at that, they're on nearly $1 billion of cash there. Profit before tax up 25%. Basic earnings per share up 29%, as you can see here. Interim dividend was hiked up as well, 130% as well. Pretty impressive from JD Sports. Such a good track record of revenue growth, and you can see the jump up here that will happen in profitability when the full accounts do close, and we should see the company start pushing more and more higher up in revenue and profitability, and that's where we're going to see the company realistically trade to more 11-12 times earnings. Cracking balance sheet, obviously throwing off good amounts of profitability, sit on around 4% debt to equity, which isn't bad at all. Like we said there, 1.4 billion of cash, so great chunk of cash on there. That's going to also help them hike up the dividend. Obviously we've seen the hike up in the dividend going forward, and we got the signs that this was very cheap through the last few months because the insider buying was absolutely insane as well. So yeah, I'm really happy I bought a good chunk into JD Sports in the last couple of months, and maybe this is probably my last buy into it if this is the bounce that it's going to have now. The next one is Barratt. So I have been buying some more shares in Barratt Development. I've always said with UK house builders, in the long term, they're okay. The next 12 months is going to be choppy. We are quite fine to that next 12 months now. I think we are towards maybe the last couple of months of it being choppy. And I think in the long term, UK house builders are quite safe investments because we just are so short of UK houses. And you can see here, really, during 2022, the house builders getting killed off because of the higher interest rate environments. And we've had basically the stock realistically not do anything in the last 12 months. Now, recently the shares have had a little bit of a pop-up, like JD Sports, we're up 37%, and maybe this is the bottom for the house builders, so maybe this once again is my last buy into it. But as you know, Barratt Developments, they build houses in the UK, maybe a little bit more to the higher end. I also like Barratt because they've got a good reputation. Well, new house builders, new homes don't have great reputations, do they? But these guys are probably one of the better recognised UK house builders. Put it this way, they're not called Persimmon. So, and as we know, at the moment we're so short for houses, and I think the target is to have 300,000 a year by the government. We're currently, well, last year we actually built 211,000, so we're still 90,000 short. And because of the slowdown at the moment, that demand's only going to get more and more as well. So we are going to need more houses, and also what we're starting to see now is we're starting to see the UK mortgage rate start to balance out. We are thinking they're not going to go any higher now, so this will also indicate a bottom, and in fact we might see them get a little bit more competitive and start coming down, which is really good. And obviously it marks a year ago since the whole Liz Truss period, which would be about right for a bottom of the market, because that's when interest rates went absolutely insane. I personally thought we would hit the bottom in the UK housing in about another 3 or 4 months time, but maybe this is the bottom. And I always said, when we do start seeing the bottom of a lot of these slowdown in the UK housing market, these stocks will bounce up very quick, and that might be the bounce that we're seeing right now. So yeah, I did buy some Barrett Developments. I would not buy at current levels personally, so I am happy that I got probably one more last buy into Barrett Developments. The next one is Airtel Africa. Now I was actually really close to buying some more actually last week, but I never got around to it because of work being so busy, and then it actually had a bit of a bounce up from last week, as you can see here. So yeah, I might buy some more. We'll see what happens. It does say it's 17 times earnings. Once again, this is a bit skewed at the moment because they are taking a charge because of the currency impact. So once again, this is actually more towards like a 4 times earnings ish. They do pay a lovely dividend as well. Now Airtel Africa is a telecommunication company in Africa. As you can see here, the website's looking a little bit buggy, but 147 million customers, 59 million data customers, 36 million Airtel Money customers. So they've got also a telecommunications and a mobile money platform. Obviously telecommunications is growing quite well, but also the actual 3G, and now they're moving on to 4G, never mind 5G at the moment, and the growth is absolutely mental. The reason why is because there's a lack of Wi-Fi infrastructure in Africa, so the actual use of data is massive. So this is why this company is growing so much at the moment, because it's not just text and also voice minutes, it's the usage of data as well, and data is growing huge. There's a ramp up into 3G, there's now the ramp up going into 4G, and then within a few years you've got the ramp up into 5G coming. So there's a lot of growth in Africa at the moment for the data side of it. The other thing is mobile money. Obviously they own a mobile money platform. There's a lack of bank infrastructure as well in Africa, and their mobile money platform is capturing some of the growth as well, which as you can see is growing 13% year over year. All mobile money counts are, and that's another growth driver for them. And overall, when you look at the numbers, they were very good. Revenue was up 19%, EBITDA was up 21%. But the problem is because of the currency devaluation, with all the currency fluctuations that are going on in the world at the moment, that isn't showing as that much as you can see here. But that's hopefully a one-time charge, and we'll see. Hopefully that calm down, and then we see these growth numbers actually start being shown without the currency impacts. And without those currency impacts, or they calm down, we should see the company go back, as we can see here, to more 10+% growth, 10+% growth in the profit margin. And once again, as we see the company start ramping up to hopefully around 750 million, and within a year's time, a 4.4 billion market cap, that looks very good. The balance sheet as well has been strengthening up, which is what we want to see. Obviously you got the potential of the dividend as well to be hiked up if they're generating more cash, which should be really good. So yeah, I really like Airtel Africa. Obviously you just got to be careful because of the currency fluctuations, but once you stabilise from that point of view, it's going to look very cheap with good growth here as well. The next one's YouGov. I'll keep this nice and brief, but I did buy some shares into YouGov. 32 times earnings, slight dividend at the moment, and I'm sure most of you guys have heard YouGov quoted with either media or on the news channels. It's a place for getting data or opinions on things, and as we know, we have a election year coming up. I think about 80% of the countries in the world have an election next year, so it's definitely boom time for YouGov, and it's become a reliable and very correct predictor of situations, and companies want to get the data to see what they want to be advertising at potentially, or where the trends are at, and as well as that, a lot of media outlets potentially use it for getting data, and it's got a good expansion plan now to move from just the UK and some more Western European countries into more Eastern Europe and into the US as well. Now, I have just dropped 2 weeks ago a video talking about why I have bought YouGov stock, which is around 16 minutes long. So with me only talking about this 2 weeks ago in a big in-depth video, I'm not going to talk about it any longer on here, because if you do want to see more of an opinion on YouGov, then go watch that video there. And then that leads me on to the last stock that is on this video today, which is AlphaWave. So AlphaWave is my play into the semiconductor space. I've always wanted to have a play into the semiconductor space, and I've gone with that with AlphaWave because it seems a lot more reasonable valuation compared to a lot of the other semiconductor producers at the moment. Now, I do keep this a smaller position because of my lack of knowledge in the area. That's something to be careful of, but with the risk that there is there, I believe there potentially could be good reward in this company. Now, one of the main reasons I did invest in this is because of the management team, who have made maybe some questionable decisions previously, but have seemed to be getting it right a lot more. But they do have a very good track record. So, for example, Tony Palace is currently the co-founder of AlphaWave in 2017. And when you look at his history in the semiconductor space, it's absolutely amazing. So he did make a company called Snowbush, which was sold in 2007. He then also founded V Semiconductors, which was then bought out by Intel in 2012. He then also moved to Intel in a role and works there between 2012 to 2017, and then obviously going to now create AlphaWave. So if you want to have a guy running your company in a semiconductor space, you're probably wanting a guy that's already sold 2 companies in this space and then worked at probably one of the big hitters, Intel, for 5 years as well. So yeah, I'm really kind of backing on Tony here to really deliver on this business. Now, they do make a few products. So they've got the silicon IP, they currently make the chiplets, they make the custom silicon, and also they make connectivity products. Now, most of their history has been around the silicon IP, and they have been using customers like Taiwan Semiconductors and Samsung. Now they're actually moving into actually making a lot more products themselves, for example, and hopefully that's going to be the big driver to take them to the next part. Now, a lot of the costs at the moment are to go into that, and it is going to hit the gross margins because they are going to be more selling physical products. But I think this is a good opening for them to kind of serve things like the AI demand that's going on at the moment. Now, you can see the licensing in an hour was down 26%, but the royalties and silicon orders is up 35%. And even though it says new bookings were below, you can see here that actually in the first 3 weeks they did sign additional custom silicon bookings of 20 million. So if you add 20 million on 72 million, obviously you're up to 92 million, and obviously you see the increase there. So it's just a bit of timing there that I think why that looked like it was a little bit weaker. And they're also moving away from more of Chinese customers into North America customers, which is probably what you want to see your company doing as well. So hopefully we see improvements there. So as long as they can keep increasing their revenue at a good pace, which is forecast, and they now take all the costs from the acquisition out and then they start ramping up the profitability, I will be very happy to see how this company does going forward. So yeah, I think that this is definitely the highest risk one on this video that I've done today, and it's the one that I have a lack of knowledge in the space from, and I will be keeping it a bit of a small position, but at the same time I do think it's the one with the potential more upside. So comes down to a risk to reward basis on that one anyway. So those are the stocks that I've been buying from the 1st of November to the 1st of December. Hope you enjoyed me sharing those with you guys. Let me know what you've been buying as well. I always like looking through the comment section and seeing if any of you guys have been buying some interesting stocks, and I do go have a look at them. I know a few of you guys were buying like the likes of Doc Martens last month. Definitely one that I had a very good look in over the last kind of few weeks, and I did decide not to buy that one, but it gave me an opportunity to go look at that one. And there's a few ones that you've mentioned before that I've always thought are quite interesting. So, you know, let me know what you've been buying as well in the comment section. But that's the video for today. Hope you enjoyed it. I'll see you in a bit.